Good morning. I want to speak with you today about something I have observed throughout my 5 decades in the investment business, something that causes more financial disappointment than market crashes, recessions, or even dishonest schemes. It is a mistake so common, so seemingly harmless, that most investors make it every single day without realizing the impact it has on their financial future. The mistake is this: confusing the stock market with your investment portfolio. Now, let me be clear about what I mean, because this distinction is absolutely fundamental to everything that follows. When most people check their brokerage statements or read the financial pages, they are not examining their investments at all. They are observing a barometer of popular opinion. They are watching what I call Mr. Market's mood swings. And in doing so, they transform what should be a rational business enterprise into an emotional game of chance. You see, the stock market is not the economy, and it is certainly not your portfolio. The stock market is merely a mechanism, a place where shares change hands, where buyers and sellers meet and determine prices through the ancient process of auction. But your portfolio, your actual investments, consists of fractional ownership in real businesses, enterprises with factories, employees, customers, and earnings. These businesses continue operating hour by hour, day by day, entirely indifferent to the price at which their shares happen to trade on any given afternoon. Let me illustrate this with a story that may seem whimsical, but contains profound truth. Imagine that you are a minority partner in a private business. Perhaps you own 30% of a successful department store. Your partner, whom we shall call Mr. Market, is a peculiar fellow. Every day, without fail, he appears at your door with an offer. Some days, he is euphoric, convinced that your shared business is worth a fortune, and he offers to buy your share at a price far above any reasonable valuation. Other days, he is deeply pessimistic, certain that the business faces trouble, and he offers to sell you his shares for a fraction of their worth, or insist you sell yours to him at a distressed price. Now, would you allow Mr. Market's daily mood swings to determine your view of your business? Would you let his excitement convince you that your department store suddenly became more valuable overnight? Would you let his gloomy outlook persuade you that this same profitable enterprise has somehow lost its earning power? Of course not. You would examine the business itself. You would look at the sales figures, the inventory turnover, the profit margins, the competitive position. You would recognize Mr. Market for what he is, sometimes useful, often irrational, but never the arbiter of your business's true worth. Yet this is precisely what millions of investors do every day when they check stock prices. They allow Mr. Market's temporary opinions to override their own analysis of business value. I learned this lesson early in my career. During severe market declines and economic downturns, I watched experienced investors lose a great deal, not because the businesses they owned failed, but because they could not emotionally separate the market's wild fluctuations from the underlying value of their holdings. I saw people who own shares in fundamentally sound enterprises sell them for a fraction of their worth simply because they could not endure watching prices fall day after day. But I also observed something remarkable during those difficult years. A small group of investors, those who understood this crucial distinction, actually prospered. They recognized that when Mr. Market became severely pessimistic and offered shares in good businesses at absurd prices, this represented opportunity, not disaster. They understood that the market's opinion and business reality were two entirely different things. Okay, this brings me to what I consider the cornerstone of sound investment practice, the margin of safety. This principle, which I have taught for decades at Columbia Business School and which forms the foundation of security analysis, rests entirely on maintaining the proper relationship between price and value. But you cannot apply this principle if you are constantly checking what Mr. Market thinks. You can only apply it if you have done the independent work necessary to estimate what a business is actually worth. Let me be mathematically precise about this. Suppose we analyze a company and determine through careful study of its earning power, its assets, and its future prospects that it possesses an intrinsic value of $100 per share, higher force of the case. This is not a guess or a hope. It is a calculation based on financial statements, competitive analysis, and conservative assumptions about the future. Now, if Mr. Market, in one of his pessimistic moods, offers us shares at $60, we have a margin of safety of 40%. This margin protects us against errors in our analysis, against unexpected difficulties in the business, against the 1,000 natural shocks that flesh is heir to in the commercial world. But here is the critical point. If we check the stock price every day, if we allow ourselves to become emotionally invested in the ticker's movements, we will inevitably be tempted to sell when Mr. Market becomes even more depressed and offers $50, then $45, then $40. We will convince ourselves that our analysis was wrong, that the market knows something we do not, that we should cut our losses. This is precisely backwards. If our analysis was sound, then increased depression on Mr. Market's part simply means an even larger margin of safety, an even more attractive investment opportunity. I have often been asked by my students why the margin of safety is so crucial. The answer lies in the fundamental uncertainty of the future. We cannot predict with precision what any business will earn next year, let alone 5 or 10 years hence. We cannot foresee technological changes, regulatory shifts, competitive threats, or managerial mistakes. Therefore, we must build a cushion into our purchases, a buffer zone that allows us to be approximately right rather than precisely wrong. Consider the engineer who designs a bridge. He does not calculate the exact weight the bridge must bear and then build it to precisely that specification. Instead, he builds in tremendous excess capacity, perhaps 10 times what he expects the bridge to carry. Why? Because he understands that his calculations might contain errors, that future uses might differ from present expectations, that materials might weather. The margin of safety protects against the unknown and the unknowable. In investing, this margin comes from paying a price substantially below intrinsic value. But you cannot maintain this discipline if you are constantly watching prices fluctuate. The investor who checks quotations daily becomes almost inevitably a speculator. He begins to think in terms of price movements rather than business values. He starts to care more about what the market will do tomorrow than about what the business will earn over the next decade. Now, let me distinguish clearly between investment and speculation, because this distinction has become dangerously blurred in the public mind. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are. Notice that this definition makes no reference to whether you hold for a long time or a short time, whether you buy stocks or bonds, whether you use margin or pay cash. The distinction lies entirely in the relationship between price and value and in the thoroughness of your analysis. A speculator is fundamentally concerned with anticipating and profiting from market fluctuations. An investor is concerned with acquiring and holding suitable securities at suitable prices. The speculator's focus is on the ticket tape, on price action, on what others will think. The investor's focus is on the balance sheet, the income statement, the competitive position, what the business is worth. Here is the insidious danger. The habit of checking prices constantly transforms even well-intentioned investors into speculators. It redirects attention from business analysis to market psychology. It makes you care about things you cannot control and should not worry about. while distracting you from things you can analyze and should understand. I have kept records of investments over many decades, and I can tell you with mathematical certainty that investors who check their portfolios most frequently achieve the poorest returns. This is not coincidence, it is cause and effect. Frequent monitoring leads to frequent action, and frequent action in response to market fluctuations almost always destroys value. Why is this? The answer lies in human psychology, which I have studied as carefully as I have studied balance sheets. Human beings are not naturally suited to investing. We evolved to respond quickly to immediate threats, to feel pain from losses more acutely than pleasure from gains, to see patterns where none exist, to follow the crowd for safety. These instincts, which served our ancestors well on the African savanna, are precisely wrong for investment success. Okay, when you check a stock price and see that it has declined, you experience actual pain. Neurological studies conducted long after my own career began, but confirming what I observed empirically, show that financial losses activate the same brain regions as physical injury. Your body releases stress hormones. Your thinking becomes less rational. You are biologically programmed to escape the source of pain, which means selling the investment. Yeah. Conversely, when you see a price rising, you experience pleasure and excitement. You want more of whatever is causing these good feelings. You become tempted to buy additional shares, not because the business has become more valuable, but because the rising price itself feels good. This is how bubbles form. This is how intelligent people convince themselves to pay absurd prices for mediocre businesses. The investor who checks prices daily subjects himself to this psychological torture repeatedly. He experiences the pain of dozens of small declines and the excitement of dozens of small advances, none of which have any bearing on the actual value of his investments. Over time, this emotional roller coaster becomes unbearable. He takes action to stop the pain, usually by selling good businesses at poor prices or buying poor businesses at good prices. Compare this to the investor who examines his holdings quarterly or even annually. He sees only the net result of many fluctuations, which tends to be far less dramatic. More importantly, he has time between observations to conduct actual analysis, to read annual reports, to consider competitive developments, to think about business values rather than reacting to price movements. Okay, I must emphasize that I am not advocating ignorance or inattention. Quite the opposite. The defensive investor, which is what I recommend for most people, should thoroughly understand what he owns and should monitor his investments regularly. But there is a profound difference between monitoring a business and monitoring a stock price. One is analytical and productive. The other is emotional and destructive. Let me give you a concrete example from my own experience. In the early years, I analyzed a public utility company, carefully examining its rate base, its regulatory environment, its growth prospects, and its financial strength. I determined that it was worth approximately $50 per share, and I was able to purchase shares at $35. This provided a margin of safety of 30%, which I considered adequate given the stability of the utility business. For the next 3 years, the market price of these shares fluctuated wildly. At times, they traded as low as $30. At other times, they rose to $45. I checked these prices perhaps twice each year, usually when I received the annual and semi-annual reports and wanted to update my analysis. The business performed as I expected. Earnings grew modestly. Dividends were maintained and slightly increased. My original analysis proved sound. Had I checked the price daily during those 3 years, I would have experienced tremendous anxiety during the periods of decline. I might well have convinced myself that my analysis was flawed, that I should sell before losses mounted. Instead, by focusing on the business rather than the market, I held my shares comfortably. Eventually, the market properties caught up with and exceeded my estimate of value, and I sold at a profit. But more importantly, I slept well during those 3 years because I knew what I owned and why I owned it. This brings me to another critical point, the importance of analyzing businesses rather than stocks. When you look at a stock quotation, you see a number that changes constantly. This number seems important, concrete, real. It invites action, but it tells you almost nothing about what you actually own. When you analyze a business, you examine entirely different things. You look at the balance sheet and ask, does this company have more assets than liabilities? Are those assets real or inflated? Could the company survive a severe recession? You examine the income statement and ask, are earnings growing? Are they sustainable? Do they come from the ordinary operations of the business or from one-time events? You study the competitive position and ask, does this company have advantages that protect it from rivals? Can competitors easily replicate its success? These questions require time, thought, and effort. They cannot be answered by glancing at a ticker. They require studying annual reports, understanding industry dynamics, assessing management quality. This is actual work, and it is work that most people are unwilling or unable to do. But here is the remarkable thing. You do not need to analyze hundreds of businesses. You need only find a few that you can understand, that are offered at prices below their intrinsic value, and then wait patiently for the market to recognize what you already know. Or I have often told my students that the stock market is designed to transfer money from the impatient to the patient. This transfer mechanism operates through the daily habit of price checking. The impatient investor sees prices moving and feels compelled to act. He buys when enthusiasm is high and prices are rising. He sells when fear is ascendant and prices are falling. He pays transaction costs, taxes, and the bid-ask spread repeatedly. Most devastatingly, he consistently buys high and sells low, the opposite of profitable investing. The patient investor does the opposite. He analyzes businesses when he has time to think clearly, not when markets are in turmoil. He buys when others are selling, not because he enjoys being contrarian, but because that is when prices are most likely to be below value. He holds while others trade, allowing compound interest and business growth to work in his favor. He does not confuse activity with achievement. Let me address a question I frequently hear. But Mr. Templeton, what if I am right about the value, but the market never recognizes it? What if Mr. Market repaints? This is a legitimate concern, and it brings us back to the fundamental nature of what we own when we own stock. A share of stock is not a lottery ticket. It is not a betting slip. It is a fractional ownership in a business. Business generates earnings. Those earnings either get paid to you as dividends or get retained and reinvested in the business. Over time, if the business is profitable, these earnings compound. This compounding is the source of investment returns, not the opinions of other market participants. Let me demonstrate with mathematics. Suppose you purchase shares in a business that earns 10% on its book value and retains all earnings to fuel growth. Your shares cost you a price equal to book value, so you are paying $1 for each dollar of net assets. Each year, the book value of your shares grows by 10%. After 7 years, the book value has nearly doubled through the magic of compound interest. Now, even if Mr. Market remains pessimistic and continues to price the stock at book value, your shares are worth twice what you paid for them. You have made money not through market appreciation, but through the earnings power of the business itself. Of course, in reality, markets do eventually recognize value, if sometimes slowly. But the key point is that you do not depend on market recognition. You depend on business performance. Now, this is why I place such emphasis on buying shares at a discount to intrinsic value and on diversification. If you own shares in 10 such businesses, purchased at substantial discounts, the laws of mathematics and probability work in your favor. Even if one or two businesses disappoint, even if Mr. Market remains irrational about several, the portfolio as a whole will grow as the businesses generate earnings and compound their value. But this patient approach requires that you not subject yourself to daily emotional trauma by checking prices. You must give the process time to work. You must maintain psychological distance from market fluctuations. You must remember that you own businesses, not ticker symbols. I want to be very clear about something that often confuses people. I am not suggesting that you ignore your investments or fail to monitor them properly. The defensive investor should review his portfolio regularly, perhaps quarterly. He should read annual reports when they are published. He should stay informed about major developments affecting his holdings. But staying informed about businesses is entirely different from watching stock prices fluctuate. Reading an annual report tells you about sales trends, profit margins, capital expenditures, competitive challenges, and management strategic thinking. This information helps you assess whether your original investment thesis remains valid. Watching a stock price tell you only that, Mr. Market's mood has changed. Information that is worse than useless because it tends to provoke emotional responses that destroy wealth. I have watched many promising investment careers destroyed by this confusion between monitoring businesses and watching prices. A young analyst conducts brilliant research, identifies an undervalued company, purchases shares at an attractive price, and then proceeds to check the quotation 10 times daily. The price falls, as prices often do, for no good reason. The analyst's confidence wavers. He begins to doubt his analysis, despite having no new information about the actual business. He sells at a loss. 6 months later, the price recovers, vindicating his original analysis, but mocking his lack of temperament. Temperament, I must tell you, is more important than intellect in investing. I have known many highly intelligent people who failed as investors because they could not control their emotions. I have known people of more modest intellectual gifts who succeeded because they possessed patience, discipline, and emotional stability. The market, you see, is designed to exploit emotional weakness. It will test your resolve repeatedly. It will make you question your analysis. It will tempt you with apparent profits and terrify you with paper losses. Only those who understand the true nature of what they own can withstand these tests. This is why I recommend that most people adopt what I call the defensive investor approach. The defensive investor is not trying to beat the market or achieve extraordinary returns. He is trying to achieve adequate returns with minimal risk and minimal effort. His primary goal is to avoid serious mistakes, because serious mistakes are far more common and far more costly than brilliant successes. The defensive investor should own a diversified portfolio of common stocks purchased at reasonable prices, supplemented by high-grade bonds appropriate to his age and circumstances. He should rebalance this portfolio perhaps once per year. He should reinvest dividends automatically. And most importantly, he should not check prices frequently. Let me be even more specific. If you are a defensive investor, I would suggest that you allow yourself to look at your portfolio's value no more than once per quarter. Even quarterly may be too frequent, but I recognize that human curiosity makes some monitoring inevitable. However, you should never, under any circumstances, check prices daily. This single habit will do more to improve your investment returns than any amount of sophisticated analysis. Why is this so powerful? Because it breaks the psychological chains that bind most investors to destructive behavior. When you check prices quarterly instead of daily, you give yourself permission to think in terms of years instead of days. You naturally begin to focus on business developments rather than price movements. You reduce your emotional involvement in inevitable fluctuations. You transform yourself from a speculator reacting to Mr. Market's moods into an investor analyzing business values. I must also address the role of bonds and conservative positioning in a sound investment program because this ties directly to the psychological question we have been discussing. The defensive investor should always maintain a portion of his portfolio in high-grade bonds or cash equivalents. The exact proportion depends on individual circumstances, but as a general rule, the bond position should never be less than 25%, nor more than 75% of the total portfolio. Why bonds? Not primarily for their modest yields, though steady income is valuable. The real purpose of the bond allocation is psychological armor. When stock prices fall, as they inevitably will, your bond holdings provide stability. This stability is not merely mathematical, it is emotional. Knowing that a substantial portion of your portfolio is unaffected by stock market fluctuations makes it vastly easier to maintain your discipline during difficult periods. Moreover, the bond allocation provides dry powder for opportunistic purchasing when Mr. Market becomes severely depressed. If you are fully invested in stocks and prices fall sharply, you face a cruel dilemma. You recognize that shares are cheap, but you have no cash to take advantage of the opportunity. This leads to frustration and often to poor decisions like selling one holding to buy another, incurring taxes and costs in the process. The investor with a balanced portfolio faces no such dilemma. When stock prices fall substantially, he can rebalance by selling bonds and buying stocks, automatically buying low. When stock prices rise substantially, he can rebalance by selling stocks and buying bonds, automatically selling high. This mechanical process removes emotion from the decision and enforces the discipline of contrary action. But here again, this approach only works if you are not checking prices constantly. If you see stocks falling every day, you will be tempted to flee to safety rather than rebalance into the decline. If you see stocks rising every day, you will be tempted to abandon your bonds and chase returns. The discipline of infrequent monitoring protects you from these temptations. Here, let me share with you a perspective gained from 5 decades of experience on Wall Street and from studying market history extending back to the beginning of organized exchanges. Markets go through long periods of speculation, followed by painful corrections, then gradual rebuilding of confidence, then renewed speculation. This cycle has repeated itself many times and will doubtless repeat itself many times more. During speculative periods, those who check prices frequently feel brilliant. Their portfolios show gains daily. They are tempted to buy more, to use leverage, to abandon caution. They hear stories of neighbors making fortunes. They feel foolish being conservative. This is precisely when the habit of daily price checking becomes most dangerous, because it reinforces the speculative mania. During corrective periods, those who check prices frequently experience agony. Their portfolios show losses daily. They are tempted to sell, to raise cash, to abandon stocks entirely. They hear stories of ruin. They feel foolish staying invested. This again is when daily price checking becomes most dangerous because it reinforces the panic. The investor who checks prices infrequently misses both extremes of emotion. He sees neither the daily grind higher during manias nor the daily decline during panics. He sees only the quarterly or annual results, which are far less likely to trigger emotional responses. He is therefore able to maintain his discipline and to take appropriate action, selling when others are excessively optimistic, buying when others are excessively pessimistic. And I want to emphasize something that may seem paradoxical. By paying less attention to your portfolio, you will achieve better results. This seems counterintuitive. We are taught that success in any endeavor requires constant attention and effort. But investing is different. In investing, excessive attention leads to excessive action, And excessive action leads to excessive costs and poor timing decisions. Yeah? The truly intelligent investor recognizes his limitations. He knows that he cannot predict short-term price movements. He knows that his emotions will betray him if given the opportunity. He therefore structures his investment program to protect himself from his own psychological weaknesses. Infrequent monitoring is one of the most powerful protective mechanisms available. I realize that what I am proposing runs counter to modern culture. We live in an age of instant information. Stock prices are available at every moment on every device. The financial media presents this constant stream of quotations as if it were valuable information. Brokerage firms encourage frequent checking of your account balance. The entire apparatus of modern finance seems designed to make you watch prices constantly. But I am telling you, based on both theory and experience, that this constant monitoring is actively harmful to your investment results. It is not merely useless, it is destructive. It transforms you from a business owner into a speculator. It redirects your attention from what matters to what does not. It triggers emotional responses that destroy wealth. And if you take only one lesson from this discussion, let it be this: the stock market is not your portfolio. The market is a mechanism for buying and selling. Your portfolio is a collection of businesses. These businesses have value that exists independently of daily quotations. By maintaining this distinction in your mind, by focusing on business analysis rather than price watching, by giving your investments time to work without subjecting yourself to emotional torture, you will achieve far better results with far less anxiety